like me, you love the idea of having tax-free income in retirement. And the primary way you do that is by investing in Roth retirement accounts. Having more money in a Roth is really nice because the account growth is never taxed if you follow some basic rules. However, the problem for many people is that Roth IRAs have income limits. They prohibit high earners from contributing. But there are some easy options and workarounds to consider. So this podcast will review Roth benefits and 4 ways to boost your Roth investments regardless of income. Hey friends, thanks for joining me on another weekly Money Girl episode. I'm Laura Adams, a personal finance and small business author of several books, including Money Smart Solopreneur, a personal finance system for freelancers, entrepreneurs, and side hustlers. It's from Entrepreneur Press, and it was a #1 Amazon new release. It's available as a paperback, ebook, and audiobook. If you're enjoying the show and want to support the free content that we love creating, consider submitting a 5-star rating or review on Apple Podcasts, Spotify, or wherever you're listening. And if you have a question you'd like me to cover on the show, you can leave it on our voicemail at 302-364-0308. You can also send me an email and sign up for the free Money Stack newsletter at lauradadams.com. All right, so let's talk about what a Roth IRA is. Many of you know that stands for Individual Retirement Account. And unlike a pre-tax traditional IRA, with a Roth, you don't get upfront tax deductions. Those contributions that you put in are taxed in the year you make them. However, a Roth allows you to make tax-free withdrawals after the age of 59 and a half if you've owned the account for at least 5 years. Plus, Roth accounts don't have any required minimum distributions or RMDs. With a traditional retirement account, you must pay income taxes on your withdrawals, and you have to begin RMDs starting at age 73, or it will be pushed out to 75 starting in the year 2033. In addition, you can withdraw Roth IRA contributions, but not the earnings, at any time without paying taxes or a penalty. So that gives you a lot of flexibility to tap a Roth IRA for any reason. But of course, I recommend staying out of your retirement account so it can grow as much as possible. You can contribute to a traditional IRA, Roth IRA, or a combination of both of them up to an annual limit. For 2024, that limit is $7,000 or $8,000 if you're over age 50. For example, if you're 30, you could put $2,000 in a traditional IRA and $5,000 in a Roth IRA. So I mentioned that you can't contribute to a Roth IRA when you earn more than an annual threshold. The limit depends on your tax filing status and modified adjusted gross income, or MAGI for short. So let's go through the income limits to qualify for a Roth IRA in 2024. If you're a single taxpayer, you must have a MAGI of less than $161,000. But you qualify for a reduced contribution with MAGI from $146,000 up to $160,000. And you can make full Roth IRA contributions when you have MAGI under $146,000. Now, if you're married and file taxes jointly, you must have a MAGI of less than $240,000, but you'll qualify for a reduced contribution when your income is in the range of $230,000 up to $239,000. And you can both make full Roth IRA contributions when your MAGI for the household is under $230,000. And married taxpayers filing separately can use the single limits that I just covered if you haven't lived together in the past year. If you have lived together, you can't contribute to a Roth IRA when you have a MAGI of $10,000 or above. If you qualify to contribute to a Roth IRA, but let's say you become ineligible in the future because your income goes up, you can still keep your account. You can own it indefinitely and enjoy its tax-free growth. However, you can only make new contributions to the account if your income dips below the annual allowable limit. All right, so let's talk about ways to fund a Roth no matter your income. When the Roth IRA income limits make it impossible for you as a high-earning individual or maybe as a married couple to contribute directly to one, I'm going to go through 4 ways you can still boost your Roth investment balances. So number 1 is to contribute to a Roth at work. If your employer offers a retirement plan, such as a 401k or a 403b with a Roth option, it has no income limits. So it's really an amazing opportunity. Unlike a Roth IRA, workplace Roth accounts allow you to participate regardless of income. For 2024, you can contribute up to $23,000 or $30,500 if you're over 50 to most workplace Roth retirement plans. So that's definitely the best way to get money in a Roth when you're a high earner. The second option is to make mega backdoor Roth conversions. I did a podcast about this topic just on its own fairly recently, so you may want to go back in the archives and take a look. But if you have a workplace retirement account, you may be able to put additional funds in a Roth using a mega backdoor conversion strategy. It requires you to make after-tax contributions to a traditional workplace plan like a 401k and then convert them to a Roth. Now remember, you typically put pre-tax funds in a traditional account, but if you put after-tax contributions, they can be converted to a Roth without a tax consequence. And I want to just mention that not all retirement plans will allow after-tax contributions. So you need to check the rules or ask your benefits administrator if a mega backdoor strategy is possible. But if your plan allows after-tax contributions, that enables you to save more than the typical annual limit of $23,000 or $30,500 if you're over 50. If it's allowed, you or your employer can contribute up to $69,000 or $76,500 if you're over 50, as long as it doesn't exceed your annual income. So that actually leaves an additional $46,000 in potential after-tax contributions, which could come from you or your employer. So $69,000 is the limit, and let's say you put in $23,000, that gives you an additional $46,000. So for example, let's say you're under 50 and you make $100,000 a year. You could contribute up to an additional $46,000 in after-tax contributions to your retirement plan at work. The next step in the mega backdoor strategy would be converting those after-tax contributions to a Roth. And there are 2 options, 2 ways to do that. If you have a Roth at work, one option may be to convert the after-tax amounts from your traditional 401k directly over to your Roth 401k. That's known as an in-plan Roth conversion. Or if your workplace plan allows it, you may be able to roll over your after-tax contributions from a traditional 401k to a Roth IRA. That's known as an in-service withdrawal. Whether you convert after-tax workplace contributions to a Roth 401k or a Roth IRA, there would be no taxes except any earnings on the contributions. But if you do a mega backdoor conversion quickly, there should be minimal account gains subject to tax. So being eligible for a mega backdoor Roth conversion depends on what your workplace retirement plan allows. Some plans even have a feature that automatically converts your after-tax funds to a Roth at regular intervals. If allowed, you can use this advanced strategy to make after-tax contributions and do an in-plan Roth conversion or an in-service withdrawal and rollover. And the third way to get more money in a Roth is to make Roth IRA conversions. So this is another way to boost your balance in a Roth, even if you earn too much to qualify for Roth IRA contributions. So doing Roth conversions means you withdraw funds from a pre-tax account, like a traditional IRA or a traditional 401k, and move them to an after-tax Roth IRA. However, that triggers ordinary income taxes that you must be prepared to pay. So the downside of a Roth IRA conversion is owing taxes, but the benefit is that there are no annual income limits, so it doesn't matter how much you earn. Plus, you can convert as much pre-tax money to a Roth IRA annually as you like because there is not a yearly conversion limit. Those $7,000 and $8,000 contribution limits don't apply to conversions. That allows you to withdraw and pay taxes on as much money as you want to move into a Roth IRA. For example, if you want to convert $50,000 from your traditional IRA to your Roth IRA, your annual taxable income increases by $50,000, significantly increasing your tax liability. So it's critical to be strategic with conversions and only do enough to stay in the lowest possible tax bracket, or do them when you have a lower income year. And you might spread conversions out over multiple years to better manage your tax bill. Many people do Roth conversions in what are called the gap years, after they retire and they're earning less, but before their Social Security benefits and required minimum distributions start. Knowing if a Roth conversion is right for your situation depends on many factors, including the expected future benefits for you, a surviving spouse, or beneficiaries. And the fourth way to get more money in a Roth is to make backdoor Roth IRA contributions. So if you earn too much to qualify for a Roth IRA, you can also make after-tax contributions to a traditional IRA. Remember, a traditional IRA has no income limit to qualify. Then once you've got those after-tax contributions in the traditional IRA, you can convert them to a Roth IRA. While you typically make pre-tax contributions to a traditional IRA, non-deductible after-tax contributions are allowed. However, the annual contribution limits, the $7,000 or $8,000 if you're over 50, still apply. So a backdoor Roth is a legitimate way to move small amounts of after-tax money from a traditional IRA to a Roth IRA, even if you earn too much for the front door contributions to a Roth IRA. Like a mega backdoor strategy, you don't owe taxes on backdoor Roth IRA contributions, except on any investment growth earned between the time of your contribution and the Roth rollover. If you do it quickly, your earnings and resulting income tax should be quite small. However, the downside of a backdoor Roth is that if you already have a traditional IRA with pre-tax funds, you're subject to something called the pro rata rule, which requires you to lump all your IRAs together when you make a distribution. So basically, a backdoor Roth works best if you have no pre-tax IRA balances. Otherwise, the pro rata rule requires a portion to become a taxable conversion based on the percentage of your non-deductible and deductible IRA balances. It gets a little complicated, but basically, if you don't have any pre-tax IRA funds, you could move any amount up to the annual contribution limit from a non-deductible IRA to a Roth IRA without triggering taxes. There is a potential workaround to eliminate the pre-tax conflict if you have a retirement plan at work that allows incoming rollovers. Theoretically, you could roll over pre-tax IRA funds to a traditional 401k, or if you're self-employed, you could move pre-tax IRA money into a SEP IRA or solo 401k that allows it. So, that would kind of do away with having any pre-tax money in an IRA. I want to encourage you to always speak to a tax professional or a financial advisor before making any big retirement account moves. Everyone's situation and retirement plans are different, so be sure to get advice on whether paying taxes now is worthwhile in exchange for future tax-free Roth benefits. Before we go, I want to thank the TikToker IBV for her recent post about the show. She makes some great money and budgeting content, so check her out if you're on TikTok. Also, you can subscribe to The Money Stack, my weekly newsletter, when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or become a paid member with access to live educational events. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our amazing team. Steve Rickyberg audio engineers the show. Brandon Gachus is our director of podcasts. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. And Davina Tomlin is our marketing and publicity associate.